Hello, hello, hello. What's going on, everybody? Can you guys hear me in the YouTube audience? No webcam today, as I just want to keep the focus on the value and content we're going to be sharing instead of people just asking about what I'm wearing and stuff like that. But can you guys hear me loud and clear before I jump into it? Because I've been away from YouTube for a few weeks as I've been busy with some personal, family, and business related stuff. So I haven't been able to do the market update webinars or live streams or anything of that nature, right? So otherwise, because of that, this webinar is going to be a longer one as we're going to be focusing on some key fundamental review and the timeline of events that have taken place over the last month, on top of some higher time frame review and macro analysis, then jumping into the intraday time frames and breaking everything else down in terms of trade ideas for the next sessions and for the week to come. Okay? So, over the last 6 years that I have been personally involved in the financial markets, and especially as I've been more focused and in tune with, of course, understanding fundamentals, economics, and what's going on in the real world as the information advantage and driving factor for order flow, I've really started to notice that the markets are essentially like being a fisherman or a treasure hunter out onto the ocean, right? Even a lot of market terminology is related to the ocean, such as liquidity or market whales or financial sharks and so forth, right? And as a manual retail trader, with the market being the ocean, extremely vast, extremely deep, extremely intricate, with a lot of mysteries, a lot of dangers, but also a ton of opportunity and potential prosperity, your job is to learn how to best navigate this ocean without potentially shipwrecking and drowning, and along the way reaping as many rewards as you can, right? And sometimes as you navigate this ocean of the markets, it's going to feel like, or potentially be, depending on market conditions, it's going to be considered smooth sailing, right? You're just going to have very easy trending markets, very key pre-planned events in focus, such as economic data events or central bank rate decisions. You don't have this huge aggressive volatility or uncertainty coming into play, and everything is pretty much smooth sailing. Regular, well expected market conditions in terms of volume and volatility, just following with scheduled events in focus, looking at very clean trends on whatever asset class you're trading and so forth. That's what everybody loves, is when it's smooth sailing. And a lot of retail traders, once they gain that experience and knowledge, don't have a problem profiting when the markets are smooth sailing, when the ocean is settled. You're not having these huge waves or dangers or storms coming into play. But what really tests a manual retail trader, what really shows who is skilled and who has the knowledge, experience, and overall mental fortitude to have longevity in this game, are the traders that know how to weather the storms. Now, what are the storms? Well, obviously in the ocean, when you have these huge storms coming in from Mother Nature, whether it's hurricanes, tsunamis, tornadoes, whatever it may be, right? Earthquakes, fissures, whatever it may be, the conditions completely change. You'll have waves that are as large as skyscrapers. You'll have treacherous weather conditions, winds going at an accelerated rate, where it's no longer smooth sailing. These are conditions that most sailors would not be able to handle, survive through, and especially not prosper through, right? It's very similar in the markets. Whenever you have events come into play that are outside of scheduled events or anything that is not pre-planned. This is what I call catalysts that bring fear, uncertainty, and doubt, and is potentially what we call the storm hitting the markets. Heavy increases in volatility, heavy increases in indecision. The market focus completely shifts and is all focused on whatever this central catalyst is. Whether that's something like a financial crisis of the 2008 GFC, whether it's something like the pandemic and the lockdowns and the money pumping phase, whether it's something from a military perspective when we saw Russia invade Ukraine, or whether it's something like the recent uncertainties with the banking sector fallouts, like the SVB collapse and of course the Credit Suisse fallout and all the uncertainties developing regarding global banking sector. These are events that for us as manual retail traders with the resources and information we have access to, you'll never know when it's going to happen. You can have predictions that we may see another war conflict and you may see China start invading Taiwan or more escalations of World War III as Russia and China further cement their alliance and as NATO countries get more aggressive. But you'll never know exactly when it's going to happen. We don't have that insider information from our retail trading perspective. You could have predictions that more banks are going to fall out and fail, banks that were extremely dependent on a low interest rate environment and money pumping phase of the markets, where the central banks were pumping the markets. These institutions were able to get loans out at 0% interest, ride it into the markets and invest, playing that low interest rate environment. A lot more banks are suspected to fail that have just been dependent on that low interest rate environment. But it's impossible for us as manual retail traders to know exactly what bank is going to fail, and not even just what bank is going to fail, when is the most important, right? So not having that when factor, that's what brings all the uncertainty to the markets. That's what brings that complete change in, of course, market order flow and volatility and volume and so forth as well, right? In the example of gold here, you can see some of the most key bullish rallies here were from times when storms were hitting the ocean, when you had fear, uncertainty, and doubt hitting the market, whether it was the initial first pandemic phase when we were going into lockdowns a bit after March 2020, whether it was when Russia started their invasion of Ukraine, or whether it was when we've had these banking fallouts now, from SVB to Credit Suisse and so forth, right? As this fear, uncertainty, and doubt comes into the markets, you have a new reactive event that's unplanned come in, completely shift the focus of institutional order flow as they adjust their order flow to hedge against potential risks or take advantage of potential opportunities, right? This is when you have these huge, large, monstrous moves take place. But you have to understand that the market is always moving ahead of the curve. These storms do not last forever in the overall broad aspect of the ocean. And eventually, once the storm settles, if you don't have any catalysts bringing new fear, uncertainty, and doubt, you can also see very aggressive corrections or potential reversals in price as well. So let's look at something very interesting here when we're looking at gold and some of the key events. For people who are unaware, just for a quick recap, over the last month, the reason why gold went so bullish from 1800s all the way into the 2000s was a collective of events. One, you had bad US jobs data. Two, right after that, you had the SVB collapse in US banking sector. Three, the week after SVB collapse. Four, volatility around rate decisions that followed with focus on supporting these banks, all that uncertainty and doubt, right? Now, This makes sense. You have all this fear, uncertainty, and doubt entering the markets due to these one, planned events, as well as some reactive events that are out of our control, out of our predictions of when it's going to happen and take place. So you have the institutional order flow adjust accordingly to hedge against these risks by pooling more liquidity into your safe haven asset classes. During this time, Japanese yen is holding more strength, gold is holding more strength, and you're seeing downside and bears on the global stock markets and other risk assets and risk currencies, right? But what you have to understand is now that these events have taken place, we're reaching very key historical high price points where solutions have been provided for these events. So there's still this macro fear lingering, but solutions have been provided. These issues have been contained. And so far, if we do not get any new fear, uncertainty, and doubt, we have to understand something, that what is it going to take for us to see gold breaking above 2,000 an ounce, right? Because now when you understand this, you have to come look at gold in very key price points of interest. This is what's important for us as manual retail traders, is one, not just understanding the impact of fundamental events and potentially taking advantage of that, but two, also being able to anticipate and understand when the market has adjusted to these fundamental events, the events have been priced in, and it's no longer holding much weight. Now you have to look at something very interesting here, as you get a lot of information from key price points of interest. When you're looking at gold here, roughly in this higher time frame range and key liquidity zone, digging from about 1950s into the low 2000s, right? You can see there's only been 2 times where we have peaked above these price points, and those were due to very large fundamental catalysts. And you also have to understand that when we peaked above those price points, the upside was relatively short-lived as well. So let's break that down. Okay, so now, movement of price, volume, and volatility, regardless of the fundamental uncertainty and doubt catalysts, has a very similar impact on gold and very similar reactions at key price points of interest as well, right? So here, obviously, during that post-March 2020 phase, when we had COVID and the global lockdowns obviously take place, which was something we've never seen in our lifetimes before, this brought a lot of fear, uncertainty, and doubts. The same time you had the money pumping phase of the Fed start to take place, where you had an exponential increase in money supply, interest rates at zero, and them starting to obviously pump the markets and the institutions riding that wave. But this led to a huge explosion in gold price. You can see similar volume and volatility where you just have consecutive days moving hundreds and hundreds of pips, right? Now, we broke above that key 1960s and 2000 price handle, but with that catalyst, it was very, very short-lived. As the events got priced in, the markets made their money on the moves accordingly, and we didn't have any new events to price in, right? You could see buyers liquidating positions after this extended aggressive rally, sellers jumping in from better price points of interest, and a very aggressive correction that follows, right? So due to the new events of global lockdowns and low rates and money pumping, gold broke above the 2000s, but for only about a week before having a very aggressive correction, that information advantage there with the fear, uncertainty, and doubt being priced in. And even though lockdowns remained for the globe and masses to deal with, the markets are always moving ahead of the curve and always moving on anticipation, so that information was already well priced in, wasn't holding any more impact, right? Then you can see here what followed up in the last time we saw a very similar increase in volume of gold to the buy upside was during 2022 start, where of course we had Russia invade Ukraine. Global war escalations, Russia invading Ukraine, failing to break this key demand zone and hitting lower price points of interest into the 1760s, led to some more demand in gold through that period of time where those escalations on the war front were still fresh. Very similar volatility where you see gold just moving up hundreds of pips for days. Due to the new event in recent history of Russia invading Ukraine, we saw gold break above 2000s, but again, very short-lived as we just stayed up there for about 3 days. Then we still end up breaking and retesting below the 1960s and having a very large correction. The market's moving ahead of the curve on anticipation, already priced in the majority impact and events to take place and occur with the Russia invasion of Ukraine. And even though Russia is still actively invading Ukraine to this day, It's no longer holding impact to the markets as the events have been priced in, right? Then here we had this huge correction take place as the Russia-Ukraine tensions were priced in, and the most aggressive rate hike cycle in history was started by the Feds, and we had the dollar domination narrative. Now, we're seeing very similar upside rallies from these fundamental catalysts. And you can see this time, the reason we see gold exploding from the 1800s all the way back into that same 1960s was not lockdowns this time, not war escalations, but banking sector fallouts. Now, in Capital Hungry and on YouTube, I already predicted that a lot of institutions would be suffering and potentially fall out during the most aggressive rate hike cycle in history. That's not something that takes a genius to understand. Institutions that were heavily dependent on a low interest rate environment and could not properly invest otherwise are obviously going to be feeling the heat when the Federal Reserve does the most aggressive rate hike cycle in history. And that's not even an impressive prediction to make. Now, nobody could know what exact institutions are going to be failing and when they're going to be failing, unless you have insider information. There's thousands of institutions within the US, right? And hundreds of large ones. So what's really interesting is from this very similar price point where we had the Russia-Ukraine tensions come into play and this explosion in price, this huge explosion in gold price during that fear, uncertainty, and doubt. And here, it's almost really surgical, right? Here, as soon as we had the banking sector fear, uncertainty, and doubt, it was all around the 1800s here. And what's also very interesting is the size of the rallies and where the rallies potentially start to stall out here. But what's more interesting about this case of the banking sector fallouts is that we have not broken above the 2000s yet. So we have to start asking ourselves the question now. Every time we do break above the 2000s, so far it's been relatively short-lived. And every time we broke above the 2000s, it was a relatively large, real-world fundamental catalyst that led to that move. Here, global lockdowns, something we've never experienced in our lifetime before. Here, almost leading into World War III escalations with Russia invading Ukraine, again, since last 2016 period, right? Here, even though we had Silicon Valley Bank collapse within the US, even though we had Credit Suisse fallout within Eurozone, we had enough liquidity and buyer demand to come to the 2000s, but not break above just yet. So what's it going to take, in my opinion? These are just some examples, but in my opinion, if we don't get any new fear, uncertainty, and doubt catalysts, you can see highlighted in these pink boxes I'm creating here that it's very common to see aggressive consolidations that can occur here or indecision, as gold can be bouncing potentially from the 1940s up until the 2000s there. Right? Does that make sense to everybody? So you can see so far we've had buyer liquidity pooling in from very similar price points as previous fear, uncertainty, and doubt catalysts around the 1800s. Very similar move in terms of price action when you have that increase in volume and volatility as a storm is hitting the ocean. A reactive event is hitting the markets, right? But we have yet to trade and hold above the 2000s on the higher time frame here. And something to note is even when we did trade above the 2000s from a historical standpoint and just looking at very key events, over the last 3 to 4 years, whether it was the lockdowns with COVID or whether it was Russia invading Ukraine, the upside above the 2000s was relatively short-lived. So yes, you would get these moves going from like 2000 to 2060 an ounce here on gold, but this time during the lockdown, it was only for about a week until the events were priced in and gold saw a major correction. This time during Russia invading Ukraine, it was only for about 3 days before you had the events priced in and gold doing a large correction. And this time, we haven't even actually traded above the 2000s or revisited those price points yet either. So, in my opinion, there's a high probability, especially if you're understanding market timing, as we're approaching the end of the business month, and of course the end of the first quarter of 2023, that if we don't get any new fear, uncertainty, and doubt events, that we can see a very similar repetition of potentially seeing gold just ranging from the higher time frames of the 1950s up into the 1990s. And if we don't get those events, we might not see gold trading above the 2000s anytime soon. We might see a slowdown in volume and volatility, some potential corrections, and some potential secondary phases of market structure. Right? Because you also have to understand, it's not just that these events have been priced in. The SVB fallout within the US banking sector has been contained and doesn't have any further major systemic risks. Credit Suisse issue has already saw a solution with it being bought out by UBS and having support from the ECB and policy makers and so forth, right? So a lot of these fear, uncertainty, and doubt catalysts that saw gold surge to these price points, the information has been priced in, but also solutions have been provided for those events. Right? But you also understand that as you're watching your day-to-day headlines, you're scanning news, you're seeing what real-world events are coming into play to impact the markets, that if you see another major bank falling out, if you see some escalations with China invading Taiwan, or the West versus obviously Russia and China now, if we see continued terrible economic data showing the globe is plummeting into a deeper recession, then you know you'll at least have that clean move to play from 2000s into the historical highs of the 2060s at least. Right? But yeah, just wanted to give that macro review because the same time we're seeing gold come to these very key higher time frame liquidity zones, as a lot of these events have been priced in, we're closing off the business month and business quarter. You also have other asset classes and trading pairs at very key price points of interest as well. So with the example of, let's look at the dollar here. Now, dollar is still very bullish on the higher time frame. We're getting a potential indecisive candle close here. But the reason why dollar was so bullish here, and if you understand the price formation of dollar movement, and potential key zones of interest and historical price points, you're going to see something very interesting with dollar movement. Now, the reason for this extended upside rally on the dollar was Fed shifting from supporting economy, aka pumping markets, to tightening financial conditions and fighting inflation. Most aggressive rate hike cycle in history. Oh, you can't see that there because the Magickeys. So that removes demand in risk assets as the investing environment is completely shifted on its head, and the greedy stock market buyers just want low interest rates, Feds pumping the markets, all the whales riding that wave, inflation continuing to inflate the asset prices that they own, from their homes to their land to their investment portfolios to their businesses and so forth, as the people continue to suffer and pay the price. Now, you can see every time dollar has extended upside rallies, seeing some 50% correction phases of those rallies to potentially be revisiting some key higher time frame price points of interest is not out of the ordinary at all. We have to understand that the way dollar surged through 2022, it peaked into historical highs where the excessive upside volatility in the dollar was having a negative impact and negative implications to global economies, right? To other countries' economies. It was having impact on debt payment obligations, as majority of global debt is within US dollars. It was having impact on other countries' currency values, as we saw countries like Japan doing currency intervention, China doing currency intervention, even the UK doing currency intervention. We saw EURUSD go to a historical low and parity point of being 1-to-1 value to the dollar, right? So we may just be observing the charts as retail traders and saying, oh yeah, look, big green candles, dollar go bullish. But this movement of price on these asset classes that we trade, it has real world impacts to economies, prices, debt, inflation, and so forth that a lot of people don't understand because they choose not to get involved in learning it, even though learning it's so beneficial. But anyway, so dollar had this huge surge. Now, right into the end of 2022, as a lot of the rate hike cycle information so far was priced in, and we were told at that time we were getting some improving inflation, which now we found out was actually false, and we have data revisions from the Bureau of Labor Statistics. But anyways, you get this larger correction in price. But when I'm looking at dollar and understanding market structure and understanding how this currency behaves from a historical perspective, we're still extremely bullish, and all we're doing is a 50% correction of this large bullish impulsive rally we saw during the dollar domination phase and the most aggressive rate hike cycle in history, where the rate hike cycle is not complete yet. The fight on inflation is not complete yet. The Feds have not pivoted yet. If we still see inflation reports are rising, if we don't have any fear, uncertainty, and doubt back in regards to the US economy, and if the Feds still continue to tighten financial conditions, and we cannot break below this 101 price point here, then it's still looking very similar to see that historical repetition of just having a pullback to collect buy orders from better price points of interest and starting to slowly trend back up into those 25-year historical highs. Now, look at something very interesting here. The same time you're having dollar do a pullback from higher highs in bullish structure, fundamentally bullish due to the most aggressive rate hike cycle in history by the Federal Reserve, and obviously the dollar being your world reserve currency and business currency. The same time you have it doing a pullback to retest previous significant highs, look at what you have taking place on GBPUSD and EURUSD. This is why, even though in capital hungry, we've been adapting to this short-term dollar downside accordingly, as as soon as we started to see the pullback occur into the new year, we already had very large expectations we could be coming to retest this key liquidity zone and price sensitivity area around 101, right? We already had those expectations, but it's very difficult for me to see any more dollar downside bias or be playing dollar bears if we cannot break below that price point and we still have fundamental catalysts showing that the Feds are going to continue to tighten financial conditions and keep interest rates up into the next year or two, right? Potentially seeing still a correction in bears on the stock market and still gold stalling out if we don't have any new fear, uncertainty, and doubt events. But there for sure will be more banks that fall out. It's almost expected by the Feds. It's expected by the government. It's well known by economists. It's just obviously going to have market impact as these banks actively do fall out. But anyway, so the same time you see dollar as your world reserve currency and global business currency having that aggressive pullback phase, still from historical highs printed by buyers that we haven't seen since the 2000s, right? For like 20 years, we haven't seen dollar at these prices. A pullback that also occurred setting up order flow for the new business year, right? Profit taking at the end of 2022, setting up prices still the first quarter of 2023 here, and still having the Feds tighten financial conditions. Look at what you see when you come look at EURUSD and GBPUSD, right? So GU during the dollar domination phase printed new consecutive lower lows here. And ever since we had more strength in the dollar and less demand in risk currencies, with first the Russia invasion of Ukraine, then the Fed's most aggressive rate hike cycle in history, you can see that a lot of us got very blessed during the dollar domination phase, as pretty much every single week you're just selling GU, you're just selling EURUSD, you were just buying USDCAD. You know what I mean? But it's not out of the ordinary to see aggressive corrections occur. Look at this example here that we're going to highlight. And the very similar historical repetition and higher time frame analysis. So obviously adapting to key price points of interest and pullbacks is one thing, but you don't want to start to marry a bias without the confirmation. So look at this example here, where you have this extended downside rally, at that time printing new historical lows that we haven't seen before. And then for almost an entire year, you have this pullback phase that's about a 50% correction of this extended rally. You just go to retest those previous historical lows, fail to break, and still have overall higher time frame structure valid, revisiting these previous lows printed. Now here, as we retested this liquidity zone during the invasion of Ukraine, as there was less demand in risk currencies, more demand in dollar as a safe haven currency, as the military escalations weren't involving the US, right? From a direct perspective anyways, obviously a lot of money laundering in Ukraine. But then obviously with the most aggressive rate hike cycle by the Feds, extended downside move, printing new significant lower lows, having GU almost go to parity point. Now at the end of the year 2022 and 2023, we're getting about a 50% correction, and also just coming to retest those previous significant lows, roughly in this area here. Even though on the intraday you may have been playing some of this dollar weakness and upside here accordingly, look at GU when it retests liquidity zones on the higher time frame. Look at it here. You retested over a period of months. Range still had sellers come into play. Look at it here. Look at it here. Look at it here. This is just how this pair behaves and how it's been behaving for the last 20 years. Look at it here, even prior to the dollar domination. You retested that liquidity zone at 1.4 for a period of weeks, 2 months. Now, that's the same thing I'm seeing here. It's very difficult for me to see any GBPUSD upside unless dollar has a fundamental reason for bears, is trading well below 101 and 102, and we would need GU not just breaking above these intraday rejections you may notice on the 4 hour here, but these intraday rejections are at a key higher time frame price sensitivity area. No different than the price formation and pullback that occurred here and how we stalled out here. No different than this. Does that make sense to everybody? So a lot of people now, they're saying, gee, well, look at 4 hour on GU. It's looking very bullish. And yeah, we've been playing some of these pullback buys accordingly. Obviously, when you're having a higher time frame pullback, you don't want to be just trading against it for no reason. But where these rejections are occurring here at 1.24, this isn't just an intraday resistance here or an intraday price sensitivity area. No. This is that higher time frame zones we're highlighting. And still having very, very similar historical repetition that's taking place. Right? Look at how many times when we're zoomed in here, you can be stalling out, trapping buy-side liquidity, looking like buyers are going to be coming into the market, and still completely having extended legs down. And this one being the larger one, with, of course, printing new lows. New lows printed, just highlighted in that red circle. And then having a pullback phase on the higher time frame that's only a 50% correction of that downside move. Where'd it go to retest? Roughly previous key liquidity zones and lows. And look, at that time on the intraday, you're very bullish. At that time on the intraday, you're holding a support. You're looking extremely bullish. You're consolidating there for weeks. You still don't break above. You still have sellers come into play. Same thing here. As we fail to really break into the new lows, this just being relatively negated might as well be a wick, as it was very short-lived. Right? But here, same thing. You're having a pullback phase, order accumulation, better price points being set up on an institutional perspective. Adapting to the buys during this phase, completely understandable. It's what you should be doing. But as you're approaching key higher time frame liquidity zones, you have to start asking yourself, do we have any reason to be trading higher than here? Are we technically breaking above there? Do I still want to be looking for continued buys? And then look at the same thing here. For a period of weeks, you're still bullish. You go all the way back to those highs again, reject, and then boom. Impulsive leg down to print new consecutive higher time frame lower lows, just highlighted with this red circle, and a pullback phase that we've seen for this new year so far, which is roughly a 50% correction, coming to retest this key higher time frame liquidity zone. All I'm saying is we may see GU squeeze a little bit higher, maybe even do a little bit of a fake out, but if we're still holding below 1.245 and 1.25, don't get trapped on the higher time frame and intraday time frame like these situations, which we'll do in a distinctive blue arrow here. Because the pullback we've had from these lows in that bullish structure, perfectly fine playing that pullback. Expecting that pullback to retest a higher time frame zone, perfectly understandable. But do we still want to be continuing to look for buys here without the technical or fundamental reasons? I don't know. Potentially maybe just a little bit of upside before sellers come back into play. The same time that you have to understand from a correlation perspective, dollars holding above 102 in that key buyer liquidity zone. Still just having a pullback from highs, right? And this isn't just on GBPUSD. Look at the price formation on the higher time frame on EURUSD. Overall, still very bearish, of course. I doubt we're going to get retests all the way to structure because we got to look at the first price sensitivity area on the higher time frame. It's too big. Epic Pen's fucking up here. Right? So, similar idea. You can see here when we had this extended leg to the downside, printed these consecutive lower lows as dollar domination holds a lot more weight on a global scale. You had this deeper pullback phase, bullish structure and intraday structure at that time, stalling out there at key previous higher time frame liquidity zones, roughly in that area, right? The dollar domination phase we saw during 2022 was from that same area, and you can even see stalling out there for weeks. Impulsive leg down, new consecutive lows printed, EU going to parity point, pullback phase here in correlation to the overall downside, and a 50% correction. But not just that, very similar price formation so far of where we're just retesting a key previous liquidity zone roughly, right? So for a lot of people who have been playing the EURUSD buys and GU buys and some of the USDCAD bears and pullbacks, it's not like those trades were wrong. That was 100% correct, and what you should have been playing during this time where dollar was weak to start out the new year. But you have to be very vigilant and very focused as you ask yourself these questions. If dollar doesn't trade below 102, we still see the Feds continuing to tighten financial conditions further, and of course, we still have high inflation and things of that nature. Plus, if we have more global market fear come to the scene, like banking sector fallouts, that's going to be more bearish for EURUSD and GBPUSD, because dollar still may hold some strength or remain more stable as it's still seen as the world reserve currency and business currency at this time, right? So if you have global uncertainties take place, more global banks across different regions like Asia, looking at, of course, the Eurozone, North America, and so forth, dollar still might remain relatively stable and hold strength as a safe haven currency, while Euro, GBP, NZD, AUD, CAD, they're all a part of your basket of risk currencies, which will see far less demand during times of fear, uncertainty, and doubt. So if we get any new fear, uncertainty, and doubt catalysts, if dollar still trades above 102 on macro rate hike cycle, and we don't see EURUSD holding above 1.1, and we don't see GU breaking above 1.24, 1.245, we might see some pretty aggressive reversals coming into play and bears coming back into play on EURUSD, GBPUSD. Starting to see the bears come back into play from the 245 handle, 25 area. And on dollar, of course, starting to see buyers come back into play from that 101. I already showed you guys. My Epic Pen's fucking up now. From that 101, 102 price point here still. Right? Now, gold's going to be very interesting how this month and quarter closes, but We're at a very key make or break area. And from an intraday perspective, I'm honestly expecting to see something like this. Gold potentially, if we don't have any new fear, uncertainty, and doubt, macro fear still lingering, still having potential worries that more banks may collapse, but not having any new events to price in, obviously having a lot of the volume and volatility from the initial events already being priced in. And as we're closing off the business month and business quarter, wouldn't be out of the ordinary to see gold range for the next week or so. I wouldn't be surprised. And a pretty large range, talking like very similar to these higher time frame ranges at these very similar price points you've seen highlighted in red here, where these ranges are like 400 pips, gold just bouncing between there for days and weeks. I wouldn't be surprised seeing something very similar to that. Obviously, safer continued buys would be above 2000s, digging into the 2060s and 2050s, especially if you have new fear, uncertainty, and doubt. But if you don't have those technical breaks, if you don't have any new fear, uncertainty, and doubt, I will not be surprised seeing 100% chance almost, especially as a lot of the information's been priced in and we're setting up a new quarter. I would not be surprised seeing something like this take place. Does that make sense to everybody? A lot of the information that led to this upside, if the market's adjusted to it, it's been priced in, and you can see after very heavy volatile fundamental impacting catalysts, it's not out of the ordinary to see these indecision periods as markets remain more on edge. Whether that was after the lockdowns that initially got priced in, after Russia invaded Ukraine, or after these couple of banks falling out with SVB and Credit Suisse. Right? So that was a good little macro review on gold, key price points, pricing in market sentiment. Same thing with dollar and dollar pairs, but also what we want to look at is GJ. Now, I know GJ's been breaking my heart ever since the SVB collapse. It's been fucking dog shit. This was the SVB collapse here, and you can see, basically, to summarize for everybody, there's been this macro fight on GBPJPY. For those of you who are unaware, on the higher time frame, we've been in primarily a GJ bias ever since the initial pandemic fear was priced in, and what was holding the most weight for the last 2 years was monetary policy differentials between the Bank of Japan and Bank of England. Bank of England actively starting to raise rates and giving signals of that into late 2021 and 2022, and Bank of Japan overall, just since the start of the pandemic and through this whole timeline, keeping interest rates in the negative and continuing an unlimited bond buying program and so forth. So once the initial fear, uncertainty, and doubt was priced in from the pandemic, you can see all we did was repeat historical events. Same exact buyer demand zone that we've seen revisited, whether it was the 2008 GFC here, whether it was Brexit here, or whether it was the pandemic here. Same type of price formation where after that crisis is priced in, you have better price points set up for institutional buyers at historical lows. You get these extended rallies. What I'm seeing on GJ is still a potential repetition of the post-2008 GFC crisis and after the recovery phase there, which is highlighted in this white box. And we have to understand that this fall from grace here and drop was during Brexit, and Brexit has seen some potential solutions recently. So when we're looking at GJ, we had a lot of indecision over the last couple of weeks and months with the banking sector fallouts, but we're still respecting higher time frame bullish structure. We're still respecting historical repetition as well. And we're still respecting the rate differential between a dovish Bank of Japan and a hawkish Bank of England. So in my opinion, if we don't see any new fear, uncertainty, and doubt events for the market to price in, if we don't get any new events of military tensions or, of course, more banks falling out, especially as we're setting up the new quarter, we can easily see some GJ bounces in this area. But what I also want to show everybody is even when you're looking at this run on GJ during the historical perspective of 2013, you can see it's very, very common for GJ to retest key liquidity zones multiple times, dozens of times over months and weeks, or even retest the broken areas again and still be maintaining trend. So you can see a very similar situation here at your 149s and also here at 156. I was surprised, even with the fear, uncertainty, and doubt from the banking sector fallouts, that we didn't get deeper liquidity grabs into the 156s before turning bullish, right? So you can see very similar sequence of events. I'm going to highlight in terms of historical repetition that current fundamentals are still supporting from a macro perspective. The breakout we'll highlight with this green arrow. So the accumulation, the breakout, retest, and continue to the highs. Accumulation, breakout, retest, and then if we still are holding above 156s, if we still have the Bank of Japan keeping their monetary policy loose, continuing to accelerate inflation in Japan, while the Bank of England still focuses on tightening conditions, if we don't have any new fear, uncertainty, and doubt catalysts, if we're still trading above 156s on the daily time frame, GJ still has a lot of potential for upside here. But on the intraday perspective, it's been completely dog shit ever since the SVB fallout. You've just had this massive indecision. Huge rejections to the upside, huge rejections to the downside buyer demand zones, very indecisive candle body candle closures here, and very aggressive ranges. Just been completely dog shit, right? But I am more inclined to the buyer side here, especially on the intraday if we're holding above the 160s. Don't cancel out this bullish engulfing candle. Had some more liquidity grab the previous period there, and having a lot of the fear, uncertainty, and doubt being priced in. Now, anyways, that was just some key fundamental review, higher time frame review of key concepts. I didn't mean to make it such a long lecture, but we still have to do our intraday trade ideas and analysis. So now we're just going to be jumping into our intraday time frames, looking at what data we have for the coming sessions, and marking out some key trade ideas for people based on market structure, fundamentals, and price points of interest, and for trade ideas for potentially even for this whole week. But let's look at what we have in the next coming days. So before we jump into that analysis, we just want to do a quick market sentiment reading. So far on the intraday time frames, dollar does remain softer, but we have to keep in mind these pairs like GU and EURUSD are potentially reaching some very key sell side areas where we can see some very aggressive liquidity accumulated on the sell side here, around 1.1 on EURUSD and around 1.24245 on GU. Other than that, dollar has just been ranging and has had some indecision on the intraday time frames ever since the SVB fallout and the mixed FOMC from Jay Powell. Yen is just ranging as well here, but when you're looking at the yen individually, yen is still bearish on the higher time frames, and you're going to see what I mean here. So yen has had an extended downside bearish move as Bank of Japan has kept their monetary policy extremely loose, and just towards the end of the year, we started to have this pullback phase, right? You can see from this pullback phase, we came to key liquidity zones and still have rejections. Even though we had this bit of upside on the yen here, highlighted in the yellow box, which was from fear, uncertainty, and doubt regarding the banking sector fallouts, as long as yen individually is still trading below 78, it's still bearish on the intraday and higher time frames. So we might see another bit of a squeeze here on the yen, but it's still overall bearish below these market structure and key price points of interest here where we've seen sell side orders accumulated before. Other than that, equities are having their dead cat bounce and are just holding a support for now and just ranging. A lot of the fear, uncertainty, and doubt being priced in, but not much buy side liquidity pooling into it as we're just closing off the business quarter, first Q1 of 2023. Time has been flying by, eh? Doesn't it feel weird that the pandemic was almost 3 years ago now, 3.5 years ago now? The initial start of the lockdowns and stuff. We had the pandemic. We had Joe Biden become president. We had Russia invade Ukraine, inflation crisis, interest rate hikes shifting the markets on their head, freaking banking sector fallouts, and freaking FTX crypto scams and collapses, and a million things in between. You know what I mean? Crazy times. Feels like time's been moving on lightning speed. But equities, I'm just expecting to range and stay relatively quiet up until the new quarter. Now, before we jump into our trade ideas and analysis on the intradays, we just want to understand what events we have in focus. Nothing really going on through the Asian session. Overnight, we just have some consumer confidence reporting from France and Germany. Won't hold that much weight. Mortgage data and credit data from UK there at 4:30 won't hold that much weight. It's looking like it's going to be a pretty quiet session. It's looking like Asian, London, and New York tomorrow, if we don't have any reactive events, like based on live headlines coming in, then it's going to be relatively pretty quiet. You might just see some consolidating and ranging occur. But we'll still set up some trade ideas based on market structure, current price action, and fundamental sentiment. Other than that, tomorrow, just some ECB and Fed speakers scattered throughout the North American trading session. Now, when we're looking at gold here, we're holding below a key liquidity zone below the 2000s, but also just entering a larger, higher time frame consolidation. High probability we could just be playing in this consolidation zone to close off the quarter. So I could easily see us still just digging up to these range highs for some short-term buys and still seeing sells in this area if we don't get any new fear, uncertainty, and doubt. Or, of course, safer sells well below the 1940s. When we're looking at price action on the intraday time frame, we want to look at something very important. This was the SVB and Credit Suisse collapse that led to more demand in gold, surging into the 2000s here, roughly 2005. Information got priced in, and you saw this large correction. This was Jerome Powell bringing more fear, uncertainty, and doubt to the banking sector fallouts. Had enough liquidity to revisit there, but still failed to break higher, had this large correction. Right? Now, we're not seeing any massive optimism in the markets where we're breaking below 1940s and seeing deeper corrections, and we're not seeing any new fear, uncertainty, and doubt to have us trading above the 2000s there. More than likely, we're going to stay in this range, so we should be adaptive to that. What does that mean? Well, from a psychological and risk management perspective, your execution should be different compared to when you're playing a trending market versus a ranging market, or when you're playing periods of high volume and volatility versus periods of low volume and volatility, right? You should be a lot more selective when the markets are ranging. You should be a lot more patient with your entries and a lot more aggressive with your trade management. Compared to when the market is trending, you're probably going to have more opportunities available to you, a healthier volume to take advantage of, and overall cleaner price action translated to you as a retail trader, right? But anyways, when we're looking at gold here within this overall broad range, we can identify some key liquidity zones. We can identify the zone in this 1940s area. We can identify the liquidity into this 1980s area as well. To me, it's pretty standard and easy to understand that if we're not going to be canceling out these upside moves here, maybe just having a minor pullback, that if we're trading above the 1980s, it's pretty clean movement back into the 2000s, still playing within the range and still having a very solid range of more than 200 pips to take advantage of, which of course is great as a scalper, great as a day trader to grab your piece and get out. Otherwise, this area from roughly around 1960 to 1967 is looking more like a no trade zone, and I would only see safer sells breaking below the 1940s, as gold is still relatively bullish here just in this higher time frame range, and we're not seeing the full fear, uncertainty, and doubt being dissipated just yet. So the trade ideas I'd be looking for are buys above 1981, buys above 1988, starting to just extend back to the range highs, potentially looking for key rejections. Obviously, if we get like freaking Taiwan getting bombed, obviously don't look for sells at the 2000s. That's going to be the catalyst I was explaining to you at the start of this webinar for gold to have a reason to break the 2000s. But if we're just having gold doing regular market movement, coming back into the 2000s and you don't break, you can easily reject there and still have very strong reversals within the zone. Let me show you guys a couple of examples, right? This is a huge example, but you can see roughly gold was trading in this range for an extended period of time. Now within this range, you had huge moves roughly to about 1990 an ounce. Short-lived move here, but you get the idea. You can see a wick to the range still fully rejected. You can see here came to the top, still fully rejected. You can see here came to the top and still fully rejected. If you don't have the technical breaks and closures above that key liquidity zone on the higher time frame, or a fundamental reason for it to break higher, yes, you can play the buys up to there within the range and stay relatively adaptive, grab your piece of the pie and so forth, but don't get married to the bias just expecting us to explode without a reason, right? Another example is, you can see that here as well. So you can see here, for a lot of technical only traders, all they see is a downside move, a dip, a support being created, and time to rally and go to the moon, right? And obviously you're holding that support for an extended period of time, and you're having great day trades within here. Nothing wrong with taking the buys up to the range highs and so forth. But you can see over a period of months, 1, 2, 3, 4, 5, 6 rejections at the same liquidity zone where everybody thinks you're finally going to break out, but you don't. You don't get the fundamental reasons to break out. You don't get the technical reasons to break out, and you still end up having a deeper downside move and correction. Here, this is when gold was also very bullish at the time, right? Bullish structure from the lows. And here, same idea. You can see gold in this range from 1870s to 1900s, 300 pip range for weeks, right? I'm not saying there's not great buys within the range here, but overall, if you don't break that key higher time frame liquidity zone you can identify, you can retest there 10 times. If you don't have a fundamental reason or the technical breaks higher, there's no reason to be continuing it. Now, this is a similar, this piece of market structure I'm showing you here. This piece of market structure I was showing you to the left here. This is exactly what we're trading on gold right now. It's no different. I would not be surprised gold staying in this range to close off the quarter, potentially even to set up prices into the new business month. Would not be out of the ordinary. Can we play buys up to these range highs if we have the confirm? Sure. Should we just marry the bias and pray and put our hands together and hope for a breakout? No. Still have to be very objective, looking at both sides of the coin here. Does that make sense to everybody? And especially when you're just doing that quick little brief back testing, you can see it's very normal after you have major fundamental catalysts or gold, or after gold has done some trending for a consistent period of time. It's very normal to see these higher time frame consolidation phases. Right? So again, for us to be trading above 2000s, we need fundamental catalysts or clear confirms of that. But for the time being, can we still easily be playing in this higher time frame range? For sure. Starting to watch in this area accordingly. Otherwise, I'd only be looking for sells back in the range below 1965 and 1953. This marked out in blue is going to be a relatively no trade zone for me. It gets a little bit messy in this area, especially when you're looking at the range here. Even here, right below the 80s still. Gets a little bit messy in this area. The blue is going to be a no trade zone, no trade area for me. I'll let price action and confirmations develop. Keep in mind my personal predictions and expectations of volume and volatility. If we don't have any new reactive events, with the lack of economic events, rate decisions priced in, fear, uncertainty, and doubt catalyst priced in, end of the business month and end of the quarter, I'm expecting low volume, low volatility, more aggressive ranging on the intraday and lower time frames. Now, GU. Similar idea here on GU, right? Can we see a little bit more upside on GU digging into 1.24? Sure. But overall, very difficult for me to look for any further buys without dollar breaking below 102 and without technical breaks on GU above 2.4. So on GU, I'd be looking for, if we hold this zone buys and break above 1.236, still some of the short-term buys. As I've stated, even in capital hungry, we can still revisit this 2.4 area. But I would start looking for those higher time frame sells around 2.4 if we reach there. Especially when you understand the higher time frame back testing we just did and understanding the fundamentals. Or if we invalidate this buy area and break below 2.3 and 2.24, just jumping back into the higher time frame sells. On EURUSD, we could still squeeze up to like 1.1 here when you're looking at the higher time frame and intraday. I'd be looking for these price formations and confirmations. Otherwise, just safer continued sells. If dollar strength starts to pop back above 103s, EURUSD breaks below key level 1.079, 1.073. USDCAD, I could see us having deeper liquidity grabs to this zone of interest here. and key level 1.355. If you want to sell it down to there, in Capital Hungry, we called that if we came to this level again and broke, we're potentially going to be squeezing down to here. But I would look for buy bounces in this area, or if we come back above the key levels. US 30, I'm more expecting to range, but right now you can see we're holding this support area where a lot of the banking sector fallouts and Federal Reserve interest rate were priced in. We can potentially come to revisit these liquidity zone lows and that bearish market structure at 32.8 again in the FOMC price points. So if we hold above 32.2 and break above 32.5, I can still see us having these squeezes, especially setting up prices for the new quarter, watching reactions at around 32.8 and 33K. Otherwise, sells at this point, you would need to be trading below 32K and 31,500. GJ, I like how a lot of the fear, uncertainty, and doubt has been priced in. We failed to break that liquidity zone highlighted on the higher time frame. This candle canceled out and engulfed over, closing above those previous candle bodies. Weaker bearish candle close with a more aggressive wick. Expecting if we could just grab some liquidity to the downside, we can be trending back into the 163s and 164s if we don't have any new fear, uncertainty, and doubt catalysts for the market to price in. Now, obviously, as market volume and volatility is relatively subdued, we're seeing just more of an intraday range being created here. But even if we get retest to 161.2, holds of 0.5 and breaks of 0.8, I'd be looking for the buys. I only see GJ sells at this point from a scalping and intraday perspective from current price points if we break below 160.8. But anyways, everybody, longer webinar today as we did some fundamental and educational review, broke down key events, broke down higher time frame, broke down some key price points of interest, went through some intraday analysis, a lot of talking, a lot of ranting from me, some psychology reminders, a lot of stuff. So you can always rewatch this as you wish, and I'll see everybody next time. Everybody take care. If you enjoy this content, send a like, subscribe, comment on the save stream. It's all free to do, and I'll be back to regular programming shortly.